Today, let's analyze 3 stocks where promoters have increased their stake. But first, why would a company's promoters buy their own company stocks from the market? See, promoters have many reasons to sell, but only one reason to buy. See, when promoters put fresh money into their own company, they are not diversifying. In fact, they are doing the exact opposite. They are increasing their bet on a company that they already know inside out. And usually that happens for a few simple reasons. First, they believe that the stock is worth more than the market is pricing it. You can call it an undervalued opportunity. And maybe they are expecting faster growth in the upcoming quarters due to capex, demand recovery, or better earning visibility. And in some cases, promoters buy the shares to simply support the falling stock price and absorb the selling pressure from the market. Whatever the reason, one thing is clear. Promoters buying their own shares is generally seen as a strong positive signal for the investors. So promoter buying matters, and that is exactly what we are going to analyze in this video. So in this video, I'm going to be analyzing 3 companies where the promoters have been buying recently while the broader market has been in a sideways phase. So this is Sanika, MD at RangaOne Finance, a SEBI-registered research analyst firm where your growth is our priority. And now, let's get started. Now the first company is the most fascinating of the lot because the promoter did not just buy a few shares from the market. They jumped their stake by almost 9% in a single move. Now let us have a look at the holding data. The promoter group run by Anand Group through its holding company Asia Investment Private Limited took its stake from around 55% all the way up to 63.5%. Now that is a massive jump. The group is openly targeting 50,000 crore in revenue by 2030, and the business itself is genuinely high quality. They supply ride control products across two-wheelers, passenger vehicles, commercial vehicles, even the railway dampers for Vande Bharat and locomotives. So they have already won big share with EV players like Ola, Ather and TVS iQube, and launched a sunroof joint venture with InAlpha for the premium SUV boom. The company is Gabriel India, the undisputed market leader in India for shock absorbers, struts and ride control products. Now financially speaking, profits have compounded at 20% CAGR over 5 years, and the company is almost debt free with ROE around 19-20% and ROCE of 26%, and their FY 2026 revenue grew 15% to 4,667 crore rupees. So far this sounds like a perfect story. But here is the real red flag, and this is the most important part of this segment. The valuation is extreme. Gabriel India is trading at a trailing PE of 70 to 85 times. Let me put that into perspective. The auto component industry trades at around 29 times, and its direct peer, Endurance Technologies, trades at roughly 35 to 40 times. And Gabriel's own 5-year average PE is just 24. So the stock is trading at nearly 3 to 4 times its own historical valuation. Now technically speaking, the stock has run up 100 to 140% in the last 1 year, hitting 1,388 rupees. And currently it is trading around 1,231, which is only about 11% away from its all-time high. So there has neither been a meaningful price correction nor a time correction. And at RangaOne Finance, valuation matters. We never recommend stocks to our clients which are trading at a high PE. And the best example for it is RangaOne Wealth Management. Now the stock had rallied a lot in the last 2 years and was trading at a peak PE of around 25. Now here we waited patiently for a correction, and when the valuation became reasonable near 20 to 22 PE, we bought the dip around 1,200 to 1,250 levels, and today the stock has moved above its all-time high, and because our entry was at a lower valuation, we are sitting with a much better safety margin. So if you also want such swing trades, then you can join RangaOne Basic. The link is in the description. So my honest take is that Gabriel India is a fantastic business executing a smart strategy. But this one add to your watch list, not to your portfolio at current levels. Wait for a real price correction or a long time correction that lets the earnings catch up to its stock price. Now this next company is a textbook case of an insider doing something which insiders rarely do, buying his own stock with his own money right at the bottom. Now let us take a look at the insider data. Between February 9th and February 17, 2026, one man personally bought 9.25 lakh shares from the open market, putting in roughly 38 to 40 crores of his own money. Now that man is T.S. Kalyan, the founder, chairman and managing director of Kalyan Jewellers, one of India's largest jewellery stores. And this was a straight open market purchase at an average price of around 414 to 432, and he was buying into heavy pessimism. The stock had been beaten down nearly 30% over the previous year, hitting 52-week lows around 380 rupees. And the market was nervous about two things. First, mutual funds selling the stock and an overhang of pledged promoter shares. Roughly 25% of the promoter holding was pledged as of December 2025. But a promoter buying is only half the story. The real question is the business actually worth it? And here's where it gets interesting. Financially, Kalyan is in the strongest position in its history. For the full year of FY 2026, consolidated revenue hit 35,743 crore rupees. Now that is a massive 43% up year on year. And the profit after tax came at 1,350 crore. Now that is an 86% jump. And the latest quarter was even hotter. Q4 revenue up 66% to 10,275 crore rupees, and PAT was up a stunning 118% to 410 crore rupees. And the business is genuinely improving, not just riding gold prices. They are expanding aggressively through an asset-light franchisee model. They have 150 new showrooms planned in FY 2027. And the non-South India now contributes 58.5% of the revenue, which lifts the margin through a better product mix. And high margin studded jewelry is now over 31% of the mix, pushing EBITDA margins up. Now the part that makes this even more compelling is the valuation. Unlike Gabriel India, where the promoters buying came at a crazy PE of 80 and zero margin of safety, Kalyan Jewellers is the exact opposite. Now it currently trades at a trailing PE of around 28 to 29. And if you compare that with the sector leader, which is Titan, it is over 80. And more importantly, it is about 37% below its 10-year median PE of 46.8. So company growing profits at this pace is available below 30 times earnings. Now that is genuine growth at a reasonable price, and the PEG ratio is also looking attractive. So to put it all together, this is the rare case where strong promoter conviction is backed by a genuinely attractive stock price. And for disclaimer purposes, we have recommended Kalyan Jewellers to our basic members with a very aggressive target of 53%. And whenever we recommend stocks to our clients, we give a proper buy zone, target 1, target 2 and a stop loss. And on our website, we have explained everything in detail in this section, why we are buying this stock and what the technicals are saying. And whenever we achieve any target or if the stock comes near our buy zone, we immediately drop a message to our clients during live market hours to book profits and exit the stock. So if you also want live market updates, then you can join RangaOne. And when you join RangaOne, you don't have to track the charts or the markets. Everything is handled at RangaOne Finance because your growth is our priority. And now let's move to the next stock. Now coming to the last company, it has the single biggest insider buy in the entire list. The promoters put in over 2,600 crores of their own money. Let us look at the data. Between the start of FY 2026 and March 2026, the promoter group took its stake from 46.67% to 51.67%. A clean 5% jump by buying shares from the open market at an average price of 1,775, taking their total investment to a massive 2,674 crore rupees. So the promoters are the Godrej family led by Pirojsha Godrej, and the company is Godrej Properties, the largest listed residential developer in India. So this was a high conviction buy the dip, and the stock had corrected over 20% from its highs on real estate weakness and geopolitical jitters, while the business was breaking records. And here's the detail that makes it even more powerful. Back in December 2024, the company raised 6,000 crore from institutions at 2,595 per share, and the promoters bought at 1,775 rupees. That is roughly a 31% discount to what the big institutions paid just a year earlier. And the business backs it up. FY 2026 was a record year. The pre-sales hit 34,171 crore rupees, which is up 16% and the highest of any listed developer. And the collections were a record at 19,965 crore rupees. Total income up 22% to 8,374 crore rupees. And the net profit hit an all-time high of 1,850 crore rupees, which is up 32%, with Q4 profit jumping 73%. Now they also added 42,100 crore rupees of future sales potential, over 200% of their own guidance. Now coming to the valuation, the stock trades around 1,860 near the promoter's buy price at a trailing PE of about 29, which is reasonable for a market leader growing its profits at 32%. But the red flag is real. The return on equity is low, hovering around 9 to 10%, because real estate is capital heavy and frequent equity raises like that 6,000 crore QIP dilute per share returns. Also, a chunk of the earnings comes from other income, since revenue is only booked on project completion. So if you found this video helpful, then don't forget to like, share and hype this video. And I will see you very soon in the next video. Till then, bye-bye.
Investment in the securities market is subject to market risks. Read all the related documents carefully before investing.